Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. For Francois Trahan, early exposure to econometric models that sought to forecast business conditions illustrated the importance of changes in interest rates. Over a 25-year time frame, he's developed a framework that utilizes variables that lead the business cycle and consistently have information content with respect to where markets are heading. We talk about challenging times for risk assets, distinguishing crisis episodes like the GFC in 2008 from bear markets experienced in 2001 and again in 2022. For Francois, these are all linked with commonality in how interest rates created an economic slowdown, which then left asset prices vulnerable. Now the founder of Trahan Macro Research, Francois has a decidedly bearish outlook for U.S. equities, very much a consequence of the exceedingly steep trajectory of short rates, moving from essentially zero at the start of 22 to 4.5% now. His set of macro leading indicators all point in unwelcome directions, and his view is that the equity sell-off last year is just an appetizer for the challenging market conditions that approach. We walk through the specifics of his call and his recommendations that investors seek refuge in style factors like quality, profitability, and low beta that are typically more durable when growth is falling. If the 2022 decline in U.S. equity markets was about a re-rating lower of the index multiple, 2023 will introduce flagging profits, largely a function of the lagged impact of rate increases that ultimately lower demand. We finished by learning more about the efforts Francois is making in establishing the Macro Specialist designation, an initiative designed to help professionals establish an understanding of markets and the economy from a top-down perspective in a way similar to what the CFA designation seeks to offer from a bottoms-up standpoint. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Francois Trahan. My guest today on the Alpha Exchange is Francois Trahan. He's the founder of Trahan Macro Research, a boutique firm that's delivering risk analysis and portfolio strategy solutions to institutional investors, and a firm with a data-driven approach, identifying variables that have some forecasting power with respect to the direction of equities. Francois, thanks for being a guest on the podcast today.
Thank you, Dean. Thank you for inviting me.
Well, let's get our conversation started. I'd like to do three things during the course of this discussion. First, let's explore your framework. As I mentioned, it's data-driven, and what I see in your work is this goal of utilizing a variable that tends to have some explanatory power in forecasting the direction of another variable. So you've got a lot of leading indicator analysis. Some of it's in rates, some of it's in metrics like the ISM index. So I'd love for the listeners to learn more about how you arrived at this framework. And if you can, along the way, just incorporate some of the learning experiences through some of the past cycles. We've had recessions, we've had crisis episodes. So there's been a lot that the market and the economy have thrown at us. And I'm sure a lot of learning experiences where you fine-tuned these models. So take us back to the early days for you in terms of the development of your thought process in your career. And then second, we'll talk about your founding of Trahan Macro and dive into your bearish, very bearish call in the here and now. And then lastly, I'd love to end the conversation with some discussion about your work in creating the Macro Specialist designation. So first, let's start from the beginning. Tell us about the early days for you and how you came about this particular framework that you employ.
There's many, to be perfectly honest. I'm essentially an econometrician by training, and my first job out of grad school was working for the Canadian government. So this is the early 90s, and I essentially built GDP forecasting models, tax revenue forecasting models, that sort of stuff, full time. So it wasn't the most exciting work, but what it exposes you to very quickly is the importance of interest rates, particularly in consumer-driven economies and developed economies, because no matter what you're trying to forecast in the economy, you'll have 5, 6, 7 variables in a model. The one that's going to dominate is going to be that interest rate series that you're using. And so it's not like I was in university and became a monetarist because of opinions or I like that philosophy. I got there practically speaking, if you will. So these models essentially made me realize that everything, well, not everything, but 98% of the time, business cycles are the product of a change in interest rates. And that drives a recovery and a slowdown. So that's what I learned pre working on the sell side. And then the light bulb moment that I had, and this is like 97 or 98, something like that. I put together a chart of the S&P's return with this little known indicator at the time called the ISM. It was called the NAPM back in those days. And it was a series that Chairman Greenspan referred to a lot. And so I'm kind of playing around with it. And then I realized that it correlated super well with the S&P's return. Now, I will tell you, in hindsight, it makes sense because they're both leading indicators of the economy. They're both components in the Conference Board's official leading economic index. And so it makes sense that they would be correlated, but I didn't know this back then. I just knew, wow, these two series look exactly the same. And the ISM is an economic variable. And so I bet you I could forecast that. And that's what essentially put me on this track. That's the seeds of what became my understanding of business cycles. And so I started using interest rates to forecast the ISM. And I felt like if I could do that, I had a better shot than most at understanding where equities were going, what was going to be leadership in the market, even factors. Many factors are influenced by the business cycle. So that's what got me started in this. Over time, I realized that it started with rates, but anything that's a byproduct or proxy of Fed policy will also be helpful. Slope of the yield curve, money supply, even inflation, all these things can be used to get a heads up on where economic prospects are going, essentially where leading indicators are going. And again, the variable I choose to forecast is the ISM, but that's just to get a sense of what's going to happen to equities, leadership, et cetera, at the end of the day. So I would say that's the beginning of it.
You mentioned this light bulb moment that you had in around 97 or 98, and that was early as well in my own career. And it was right around the time of the LTCM implosion. So that's 1998. 10 years later, we have the biggest financial crash in modern market history, the global financial crisis. That's a VIX of 80. Then we have a pandemic. That's another VIX of 80 in 2020. And then in 2022, we've got a raging bear market, but really not all that high a VIX. I think the high was something on the order of 36. So it's hard to say that a market's controlled in terms of a drawdown when it falls by 18+%. But relative to those previous episodes that we might call market crisis periods, this was on the milder side, even though we drew down substantially. Perhaps 2022 is a recession, 2001 is a recession, and then these other two periods are more economic, more market crisis events where vol skyrockets and there's this giant de-risking. Walk us through how you distinguish between episodes of crisis and episodes of economic slowdown or recession. How does your framework interact with these different kinds of market sell-offs?
We call 2000 the tech bubble and what happened in '08, the housing bubble, or the implosion of it. That's what those were labeled. But beneath the surface was a business cycle. And both of those events ended because of monetary tightening. The Fed had raised rates eventually with the appropriate lags. Leading indicators of the economy started topping out, and that's usually where market multiples will peak. And we embarked on a world of slower growth. And so those events are very similar from that standpoint. A bear market for me boils down to earnings. I use this chart in my work where I just show the S&P with forward earnings back to 1984. And I try to show that the major bear markets during that time frame are all periods where earnings went down significantly. So early 90s, in the wake of the tech bubble, of course. And so 01, 02 going into 03, the GFC, and then again, the pandemic low. We were already on our way into a downturn at that time. The major corrections have to do with earnings. A correction where earnings don't decline is a buying opportunity. A rally where earnings don't recover is a selling opportunity. And so I think history is really clear in this regard historically. And what you do when you look at these four major corrections in earnings of the last 30 odd years is you realize that the deeper the decline in earnings was, the more PE compression there was. And so as you know, I'm a macro guy, but most of our industry is still earnings centric from a fundamental or bottom-up perspective. But at the end of the day, we care about the same thing. I just translate it into macro. And so if you look at a chart of industrial production and forward earnings in the S&P, and I don't label them, people won't be able to tell which line is which. Ultimately, it's the business cycle that drives earnings with very few exceptions, but they do happen from time to time, tax cuts, that sort of stuff. And monetary policy in an economy, especially in an economy like the US, where consumption is unusually large. Consumption is 68% of GDP in the US. And so that just makes us very responsive to changes in interest rates. In a situation like now, where witnessing the most aggressive Fed tightening cycle of my professional life, well, I can't help but be concerned about what lies ahead. Some people have accused me of being too negative. My retort to that is, well, I do macro. Bear markets are macro events at the end of the day. Those are the tools that will help you navigate it. Show me some macro variables that are constructive right now, and there's just not a whole lot to go on.
As we prepare to start having a conversation around the setup that you see today, a decidedly negative one, as you advise clients around what you think is going to be a painful 2023 experience for U.S. equities, I want to just do a little bit more review of history. You've made the point that the business cycle is really linked to the profit cycle, so the economy and the market are linked, but not perfectly, of course. I'd love to get your rendering of that post-crisis period. So, of course, we had a giant crash in 2008, early 2009, and then the recovery, at least on the economic side, was pretty painfully slow. We were in this 2-2-2 regime of rates, economic growth, and inflation. Nothing to write home about. There were periodic spasms in other developed markets like Europe. And yet that was a pretty good Sharpe ratio time for equity investors. It was reasonably low vol, especially when you get past something like 2014 and you're into 15 and 16. And returns were solid. And yet economic growth wasn't anything to write home about. So take us through that period, just in terms of your thinking, how you were looking at markets then, and how investors were supposed to piece everything together amidst this low growth, that it actually was a decent opportunity to be long U.S. equities.
Let me go to your original comment on how crises and recessions often go together. And I would argue that they're intrinsically linked. A slowdown is a discovery process. And the slower the economy is, the more pressure there is on the system. And eventually things start to break. And it's not always obvious what it's going to be. My last day at Bear Stearns was Feb 1, 2007. And I remember that day, the stock price was $169.50. And I assure you, nobody thought subprime was going to be the undoing of a firm like Bear Stearns, or really the heart of the crises. People thought it was an opportunity. And 13 months later, the firm was gone. And so in this cycle, I try to remind people that we're only 10 months past that first rate hike. That's not a long period of time. We have yet to see the impact. You talk about these lags. People are surprised to hear this, but in an econometric model, the way that we line up variables, we line up to have the optimal fit. And so worded differently, what you find is that the full impact of a change in rates takes about 2 years to be reflected in a series like GDP or industrial production or S&P earnings. And for leading indicators, it'll be about 6 months shorter, so about 18 months or something like that. And so we're still early in this process where we don't know where the crises are going to come from. But my sense is that by the time this recession is well entrenched, and I'm stunned that we're still debating soft landing versus recession at this stage, but it is what it is. I think it'll be clear that there's a lot of weak points in the system. People got used to very low rates at the end of the day. And so what happens in the post-recovery period, you're talking about a lot of the stuff that took place in Europe, I think is probably what's in your mind when you talk about 2013, 2014, et cetera, with the events in Spain, Greece, Cyprus, and the list goes on. If policy eases quickly enough, it's going to save some companies that really should not be around. And in the case of the rolling crisis that we see in Europe, basically it was the hangover, if you will, from the downturn and the effects of debt and excess capacity on a recovery. That's very normal. It benefited U.S. stocks for a number of reasons. Number one, it weighed on the euro. And so anything that makes the dollar go up makes inflation come down. And for the stock market, that means higher PEs. In the midst of all that, we also saw China reach peak investment, if you will. That's in 2014, basically the end of the Chinese investment boom, and commodity prices reversed course. Also something that essentially gave us these disinflationary headwinds that helped support market multiples. And so it created this great environment at a time when we had a lot of these small growth companies in the index that were just about to take off. And this was really the ideal macro backdrop for those types of firms. I would say we're still early in this story. I mapped out, I did this study maybe, I don't remember, like 12 or 15 years ago, where I was trying to map out across the business cycle, across downturns in particular, what is it that investors are focused on at different levels of growth? And I was trying to see if there was anything consistent. So I used the ISM index to do this in various downturns. And what I found is that every time the ISM reaches the mid-50s, so on its way down, the word recession starts to show up in the Bloomberg news more frequently. And so I was essentially looking at word counts of different words on Bloomberg. And so it's very normal for us to have a soft landing versus recession debate in a slowdown. And this time it happened on cue, literally. The ISM broke 55 and boom, we started talking about this. And in my experience, it's when these indicators are a little lower than where we are today that words like crisis, default, more dire terminology, if you will, starts to make its way into the news flow. And it's around 45 in the PMIs. And that's also when we enter what I would call the glass half empty phase of the cycle, where investors become very negative because usually by then earnings are falling rather rapidly. And for an industry that's still very bottom-up centric, that often creates a sense of uneasiness, if not outright panic. So I think that that's what's in store for us in 2023. I don't see the beginning of the year as indicative of anything this year. I think, if anything, this is going to be a very, very difficult year where we start to feel the effects of the Fed rate hikes on economic growth. And so it's going to be very clear by the end of the summer that we're in a downtrend, and it's going to become very difficult to call this anything but a recession, in my opinion.
Excellent. Well, now let's spend a lot of time diving into your current call, your current assessment of the dynamics in markets. To preview, it's decidedly bearish. You really don't see something so specifically bearish these days on Wall Street. Everything's hedged. So it's interesting to see something that's so decided. Let's first start with a little bit of the backstory. I think it'd be great to get some of your thinking around 2021, because in a lot of ways, that's the setup year. That's the year in which the transitory inflation call just falls way behind the realities of where inflation is printing. And so maybe we'll even start at the end of 2020. As we opened the doors to a new year, the 2021, the 3-month Treasury bill was yielding a whopping 4 basis points. It's almost hard to remember how much travel we've had in terms of policy. Of course, short rates sit closer to 4.5 now. Take us back to 2021, what you were thinking, what you were observing. And then as we get through that, we'll talk about how you arrive at this very negative outlook on a going forward basis.
I started last year with a very, very bearish call, but it's a completely different one than today. You have to wind back the clock to September of 2021, where I did a conference call and I had this theme that I called Fedflation. And essentially, what I was describing was a world where leading indicators are trending lower because of the exhaustion of fiscal stimulus, pandemic stimulus, and because rates did move higher before the Fed got involved. They bottomed in June of 2020, and so they have been moving higher. So because of the pressure from rates, the pandemic stimulus that is fading, and so that's a classic slowdown, but a world where at some point inflation would force the Fed's hand, and we would see the Fed tightening rates just as leading indicators are trending lower. So essentially the Fed tightening into a slowdown. And looking back in history, you realize that that's a very rare event. I could only find 4 examples going back to the late 60s. 2 of those were in the 1970s, and none of them ended well because, again, it's the Fed that's tightening into a slowdown. So that's what initially made me pretty concerned. Now, in September of 2021, I'm saying I'm afraid we're going to be in this situation at some point. And if you recall, Powell kind of changed his tune in December last year. And so my outlook is now, this is the scenario we're faced with. And it's especially concerning because the S&P is growthier than it has been. And that means it has a lot more stocks that are very, very sensitive to changes in interest rates. And what you see in these episodes is that the first part of the bear market is PEs get crushed as the Fed raises rates. And I would argue that's the story of last year. For value stocks last year, it wasn't that unusual of a year. It's just that value was a small share of the index compared to history. And the growthier you were, the more PE compression you had. So that's a very unusual performance in the business cycle. But again, this is a unique set of circumstances. So I was very bearish because I thought PEs were going to get crushed. And what is normally the point in the cycle that is the sweet spot for growth, when the economy is just slowing, people tend to gravitate toward those growth companies. This time, growth was what was being threatened the most. So that was the heart of the bearish call in 2022. It's a 2-step bear market where you initially feel the PE effect, which is concentrated on the growth segment of the market. And that's the story of last year. And the story of this year is that we're now going to get a repricing of earnings for all stocks in the market. Again, I go back to the comment I made earlier, how bear markets are really about a decline in earnings. In many ways, last year is the appetizer. It's not the real bear market. The classic bear market is just upon us now. I realize that in 5 years, when we look back on this era, we're going to say the bear market started, I think it was Jan 2 or Jan 3 last year when the S&P hit an all-time high. But in the classic sense, where this is really about falling earnings, this is just the tipping point. Forward earnings, if you look at small cap, mid cap, and the S&P 500, really are just starting to top out. But again, these anticipatory series, knowing that earnings bottom with the economy, knowing that the economy bottoms 2 years after a peak in rates, we're talking about a story that potentially runs into 2025 for the economy. So that's a long ways away, and it's well beyond the stock market's ability to discount. And so stock market's able to see about 6 months into the future. And the advantage that looking at macro, looking at interest rates gives you is that it allows you to view much beyond that. When you follow the business cycle and you know the history of interest rates in the economy, Fed tightening and what subsequently follows, this is a pretty scary place to be because it's rare to see 2 years in a row with big declines in the equity market. But again, it's also unusual to see the Fed raise rates in a slowdown, to be behind the curve. At the end of the day, they started raising rates after inflation hit a 40-year high. And now we have to live through that. We have to basically live through the classic bear market. This is going to take a long time. I don't know if I can still call this the early innings, because I realize some people take offense to that because it feels like it's lasted for an eternity. But it's hard for me to see how the stock market bottoms anytime between the middle of next year. And that's an eternity when you're watching markets. And that can move, but it can only move in one direction, which is further out, if the Fed ends up tightening more than people believe. And so bond yields move on to new highs, then you're extending that slowdown. You're extending how deep it will be, and you're pushing that goalpost for a bottom and leading indicators, including stocks.
I'm thinking of the old phrase, long and variable lags when it comes to Fed policy. So this stuff is imprecise. And I think as you note, and we'll get further into it, the lag time can be quite long. And I think what a lot of us have come to experience in markets is a little bit more of the crisis episode that can be resolved quickly. You think about a central bank that fights back against a risk-off event that becomes too unnerving for policymakers to bear. And so the firefighting committee comes out and they've got a giant hose. And the measure of success is really simple. If you can push the VIX back down, you're winning. You can typically do it if you're a well-equipped central bank. So those episodes can come and go in a flash, but recession bear market episodes tend to take a long time. I think that's what you're pointing to. We're going to talk further about some of these leading indicators that you really emphasize in your work in terms of what you see and the predictive power of the stock market. Before we do that, let's just take a little time to have you describe Trahan Macro. So it's a firm you've founded recently. It's an independent firm. Tell us a little bit more about the firm's mission, the client base, and the product that you're delivering to your end clients.
I've worked for big banks. I worked for Bear Stearns. I worked for UBS. And so I know what that's like. I've worked for small firms. The first one was ISI after I left Bear Stearns. I don't know when I became the old guy, but I've been doing this for a while, Dean. I think I'm just not interested in doing this with boundaries anymore. And I'm fortunate enough that my work is different enough that clients are willing to support it, even on an independent platform like we have. And so I've surrounded myself mostly with former colleagues. And so these are all people I know and that I like. And I've tried to create the best of all worlds where I can say anything. I'm not going to have anybody tell me I need to have a better S&P target. I think maybe I sound more bearish than I have in the past, but it's also because I have no filter now. I have no bounds. I can say whatever I want. That's never been the case in my career. I would say that this is the most honest call I've ever done. So our client base, the same clients that I used to speak to in the past. It's the big money managers. And so it doesn't look all that different. On the road last week, 3 days, it was largely the same itinerary that I used to do. So that doesn't feel all that different. Obviously, I'm doing it with a shingle as opposed to under the banner of a huge organization. Simultaneously, I've been working on this education project for a long time, which is called a macro specialist designation, which is essentially a training course, a macro version of the CFA, if you will. And we're trying to fill the gap between what you learn in academia and what you need to be successful on Wall Street. And those are two very different things. So we're two hats, basically.
So let's get a little further into your call, into your outlook. Two things. First is, as I look at some of your work, it certainly seems that the speed and the trajectory of the tightening cycle matters a lot in terms of your calculus and in terms of what you think ultimately this monetary medicine is going to yield in terms of negative side effects for risk assets. So I'd love for you to talk about that. And then second, put it in context for us. You say that you're extremely bearish. You've been at this for a couple of decades now. Put that in context to us. Where is the Francois Trahan bearish meter? Where does it land in this cycle versus other episodes of vulnerability, both financial and economic, that you've seen in your career?
I'm definitely more bearish than I've been in my career. I think I said that on my Outlook call last year, Dean, and I feel more bearish now than I did then. You say I'm data driven, and that's largely because of my background being, I don't know that the word quant is appropriate, but an econometrician by training. And so for me, it all starts with time-tested relationships. So I'm not really the guy to turn to for big theories about this or that. It's just not what I do. I don't spend a lot of time on theories that I know are informative, not predictive. And so right now I'm getting a lot of pushback on savings, for instance. I've been doing this, I don't even know anymore, but 27 years, I think. There's no macro topic that I haven't researched 6 or 7 times. So there's some things that are just part of a narrative, but that are not going to help you understand what lies ahead. And I would say that it's at this point in the cycle where people bring that stuff up. So that's very normal. It's at this point in the cycle where everybody's a macro expert. I'm sure you experienced that as well, Dean. And if you look at my Twitter and LinkedIn comments, you'll see how there's a lot of doubters out there, and that's fine. So for me, it starts with data-driven, but always in context. It's important to know what the context is. And I use history very often to do that. The reality is that the span of a career in our industry doesn't get us to experience enough tightening cycles to be completely comfortable with what to expect. I'm a macro guy. It's what I do. And so I'm more comfortable with that than most investors will be. But at the end of the day, what gives me that comfort is history and knowledge of it. You talk about data-driven yield curve. It's forecasted 8 of the last 8 recessions. Every time CPI has been above 5% post-World War II, we had a recession, 100% batting average. Housing historically is the most consistent predictor of an upcoming recession. There's a paper written on this by this economics professor named Ed Leamer called Housing is the Business Cycle. It's absolutely fascinating. To me, the time-tested indicators make this a really easy call. You have to dismiss a lot of really accurate indicators to see this as anything other than a recession and a deep one. So why do I feel more bearish today than I did a year ago? For a number of reasons. If you asked me a year ago, remember, I'm forecasting slower growth, Fed's tightening, et cetera. I didn't think a series like the ISM would be at 48 at the end of 2022. I think someone asked me and I said 52, 53, something like that. So the data is weaker than even I expected it to be. And all the forward-looking charts I have tell me that we have 18 months of weaker numbers here. And that's a terrible starting point if we're moving lower for the foreseeable future. So that's one thing that concerns me. There's all the things we don't know. And I alluded to Bear Stearns in 2007. We don't know what's going to break in this cycle. We don't know how serious it's going to be. And I do wonder if what the government's ability to respond is this time around, because of inflation. That's one part of it for central banks, because there's a tremendous amount of government debt for fiscal policy. The debt to GDP ratio in the US is approaching levels last seen at the height of World War II. And so we're in a very different place than we were 20 years ago when we're experiencing the tech bubble downturn. The Bush administration had a lot of leeway, and they did an insane amount of fiscal stimulus. They cut personal tax rates, dividends, cap gains. They mailed checks to everybody in 2001. They did it again in the summer of 2003. They had the ability to do that. In this cycle, I wonder what our ability will be. And really what's made me question this is what took place in the UK in September when the new prime minister announces tax cuts and the bond market basically said no. I think everybody knows debt is bad. We know from studies that high debt is associated with subpar economic growth in the future. But from one cycle to the other, we just pile on more and it doesn't matter. And I think it's conditioned everybody to think it doesn't matter when there's little signs here and there that make me question whether in this cycle it does start to play a role. I look at what's taken place in Japan in the last 2 weeks, and that's unnerving. And so in the past, when you're going into a downturn, you have to think about a crisis. The weaker systems are usually in emerging markets. And so it's usually countries with a high amount of dollar-denominated debt that are export dependent. So as the world economy slows, they bring in less revenues, and the dollar tends to appreciate in a global downturn, puts pressure on their debt. This time, you have to think about what might happen in the UK and Japan and Europe in the developed world. And that's a completely different story than I've been used to. Ultimately, I always look for a way out. I always try to think about what can offset, where can I be wrong, basically. But in a downturn, historically, my offsets are two things. It's either fiscal stimulus, which, again, I have doubts on what we can do this time around, or it's being saved by growth somewhere else in the world. China in the early 2000s is a great example of that. We're going into the Fed raises rates 04 to 06, growth starts to slow, but China is going through this massive investment boom that is having ramifications across a number of economies around the world. And for an S&P that generates a third of its revenues abroad, that allowed it to perform better than would otherwise have been the case, and certainly better than the U.S. economy suggested. This time around, I just don't know where that comes from. There's no place that's large enough to offset what is happening in the developed world where everybody is wrestling with higher rates and higher inflation. What makes me much more concerned than a year ago. So obviously not knowing where the surprises lie is worrisome for me.
You've got a couple of things there that I think are worthy of commentary. First is, I think the high point in the VIX was around 36. That was when Russia went into Ukraine. That was early in the year. But the high point in terms of the market's vulnerability was probably late September, early October. This was peak dollar. It was the weakest point for the yen. Of course, it was the gilt crisis as well. And it was just very clear via some of the correlations that the dollar was really imposing itself almost as an international VIX. We can kind of trace a lot of the rally in risk assets really to the decline in the dollar from that peak in late September, early October. You've got one slide in your deck, which is really stating something that's so patently obvious, but I think is sobering to read anyway. And you write, U.S. debt is completely out of control. And we're probably going to have this debt ceiling showdown. We can argue all day long about who's on the right side of it and whether it's appropriate for the Republicans to use this mechanism to extract concessions. But it is dangerous. And the reality is that we do have a massive unaddressed debt problem. And as robust as the U.S. government securities market is, I don't think it's worthy of comparing it to the gilt market. We probably should be looking at the buyer's strike in gilts, the return of those bond vigilantes from decades ago that finally reasserted themselves. And you just have to ask yourself around the U.S. side whether there at least could be some vulnerability that we need to pay attention to. Market prices can turn on you on a dime. So I think that's worthy of looking at as well.
That's really what it is, in a way. It's the bond vigilantes. We'll save the really bad part for later that I didn't get to. It relates to housing, though. I can weave it in. One of the things that I do in the macro specialist designation is I try to show people that the macro tools that you use will change in a business cycle. But in a slowdown, housing has a lot to offer. Housing is what people call an early cycle industry, which I would say is just a different way to say that housing responds to a change in rates earlier than the broader economy. So it basically gives us a window into the future. And I think that's the point that Professor Lemur makes so eloquently. He does it by showing that housing collapses 1 year before recession takes place. And so he shows that it is absolutely the most consistent leading indicator or predictor of recessions post-World War II, better than the yield curve, better than anything else. And so along the same lines, I use it, but I use it very differently. What housing does, Dean, is it gives me confidence that the tools I'm using are still working. And so rates went up. Immediately, we saw the impact on mortgage applications and refinance data. And so households and consumers altered their behavior in response to this change in rates, which is really important. About 6 months later, on cue, leading indicators of housing, like building permits and the NAHB index of home builder sentiment, started to weaken, perfectly on cue. And those theories essentially give you a sense of what lies ahead for financial markets and eventually down the road for the economy itself. Depending on the cycle, there's 3 or 4 phases to a downturn in housing. And this one, there's really been 4. In 2021, you could see that low-end housing was starting to slow, even though rates hadn't really gone up. But we were able to figure out that it was happening because of higher inflation. The University of Michigan has very detailed data on housing sentiment, and they have sub-series: sentiment toward housing, rates are low; sentiment toward housing, prices are high. You're basically able to figure out what people are really concerned with. And so inflation is what really started this housing slowdown, but it was really in low-end housing. And then as rates went up, home sales rolled over more broadly. Very timely, nothing unusual in these charts. If you didn't know there'd been a pandemic or any of the peculiar things about this cycle, you wouldn't see it in any of this stuff. It's remarkable how on cue it's been this time around. And then about 1 year after housing rolls over, high-end housing tends to follow suit. That tends to hold up a lot longer. That's happening now. And the fourth and final phase is the most painful one. It's when employment starts to deteriorate. And that's when the bottom falls out. And so when you look at home sales, and I went through this exercise this weekend, I looked at home sales, but I deflated it across history per capita, basically. I looked at number of households, because you can't compare 50 years of home sales data with the population that's changed so much. And you realize that home sales today have only been lower than this since 1970, 3% of the time. And most of that is in the early 80s in the midst of Volcker's hiking cycle. That's where we are now. And that's before the employment effect kicks in. So that is scary to me because, again, housing is your window into the future. And that I can show you time and time again, what happens to housing eventually happens to the markets, eventually happens to the economy. So what makes me much more concerned now than I was a year ago is that I realized a long time ago that the pattern that you see in interest rates is eventually the pattern that you see in economic data. When the Fed cuts rates very aggressively, rates come down very aggressively, with the appropriate lags, you tend to get these V-shaped bottoms where the ISM will go down and then straight up, and the stock market will do the same. It looks like a V. It looks like the inverse of what happened to interest rates. So the Fed usually cuts rates quickly, but they usually raise them at a measured pace. And so the peaks tend to take a long time to unfold. Again, they're just a reflection of what happened to rates, and vice versa on the way down. The bottoms tend to be short-lived events. So the reason I'm more concerned is because the Fed raises rates and the housing data absolutely cratered. I just talked to you about home sales. The NHB index absolutely collapsed, is sitting at the levels last seen at the depths of the pandemic. And so what that tells me is that not only is the transmission mechanism working, rates went up and on cue, the housing data reflected that, but it's also reflecting how aggressive this Fed tightening cycle is. And that's the part that scares me, because if the ISM and other leading indicators later this year are going to look like the NHB last year, this is going to be a really painful one for equity holders. I didn't have that information 1 year ago. I had a framework I believe in, but now I have confidence. Now I know there's nothing funky about the transmission mechanism. It's working. And if anything, it's working really, really good in that the housing data, it looks like a mirror image of interest rates, of what the Fed has done. And that's what concerns me for later this year, with all the surprises that that will bring, and all the potential crises along the way. And throw in the uncertainty of QT, because none of us realistically know what that might mean, because we've never experienced it. And it adds up to something that is potentially very ugly.
So you've got this call that 2022 is really about the repricing of the multiple due higher rates, higher inflation. And that's obviously caused a lot of pain in stock prices, and specifically the more interest sensitive growthy stocks that you point to. And you're pointing to 2023 as really being about the earnings decline that comes from policy rates going up very quickly and then being held in restrictive territory. So in terms of how you're thinking about how clients should position their portfolios, as you know, a lot of these institutional behemoths, they can't really get out of the market. Maybe they can run a little bit more cash, but really they're limited to a reallocation of the exposure, maybe by size, by style, maybe it's factor and geography. Walk us through your work and how it leads you to conclusions about, given the damage to the economy and to earnings that's coming, how should investors position their portfolios optimally, just given that they need to be invested? What are the types of style and factor exposures that they should look for?
I believe we're at the tail end of a bear market rally. And that's been our call, by the way. We made this call on September 28th. In the macro specialist designation, we have a framework that helps people identify bear market rallies. And we call it a bear trap because bear market rallies look a lot like the beginning of a new bull market. And so they're confusing for a lot of investors. If you're focused on macro, you'll know what this is. Most people don't, and a portion of those get caught up in believing that this is the beginning of a new trend. So September 29th, in the AII, 61% of investors declared themselves bearish. And as of last week, that number was down to 33. So it's been almost cut in half. So sentiment has clearly changed with the rally. I believe this has a couple weeks left to run. And then the bear market resumes. And so I've made the analogy to the spring of 2008 when everything looked like death going into March. And then we had a 3-month spurt that was very similar to this one. S&P was up about 15%. Russell was up 19, I think. So similar numbers to what we've experienced. And again, it's faded after a while. And I think after a while is basically in a couple weeks. So what's going to work is risk aversion. It's the opposite of what has worked since late September. And so it's not a list of terribly exciting stuff, but when economic prospects are coming down, so when the PMIs are below 50 and falling, it's essentially economic sensitivity that becomes the sole focus of investors. Worded differently, once earnings start to fall, investors become obsessed with earnings. And so you want to shy away from those companies that have elastic demand. That's the cyclicals. So last year, the one factor that separated the winners and losers was valuation. As the Fed tightening cycle winds down this year, I don't think that will be nearly as influential. I think what's going to separate winners and losers in 2023 is going to be economic sensitivity or beta. And so for me, low beta or counter cyclicals, the number one thing that I think investors should emphasize. Other characteristics that investors look for in a downturn, quality. Quality tends to work pretty much throughout the entire cycle, but it's in this risk aversion phase that it generates the most amount of alpha. Everybody's got their favorite quality metric, but this is when it really pays off. Profitability, that's another big focus of investors in risk aversion. We talked about earnings, but when I was telling you about this study where we track the keywords, one that you see that shows up a lot once that ISM crosses 50 is profitability. It basically starts to rise. This is when investors are usually focused on that stuff. And the fourth one I would throw in there is domesticity. It's basically U.S.-centric investments because in a global downturn, the dollar tends to appreciate. And as bad as it feels here, we have what I would call a low beta economy when compared to the rest of the world. The biggest chunk of our GDP is consumption. And in GDP math, that's steady Eddie growth. It's not super volatile, not the way investments are or exports or trade. And so emerging markets, their GDP tend to be dominated by investments and trade and exports. And so they tend to have really volatile business cycles. And in any global downturn, they slow a lot more than the developed world does. Being careful with those stocks that have a lot of exposure overseas usually pays off at this stage of the cycle. So the dollar for me, Dean, the dollar did great last year. And then in September, when we entered this bear market rally, what I would call this revival of appetite for risk, the dollar started pulling back. I think in a couple weeks, as the market tops out, you're getting a phenomenal entry point into the dollar and US-based assets. So those are the four things that I would hone in on, but really beta, I think, is going to be what adds the most amount of alpha. By the way, the first three, when we did all this work back in September of 2021 on what I call these Fedflation episodes, so where the Fed raises rates in what is already a downturn, what you find is valuation is what drives stocks initially. And then eventually, there's three factors that were standouts. And so beta added alpha in every single one of these episodes. So all four. The same goes for quality, also worked in all four of those episodes. Profitability, I think, was 3 out of 4. And so that's where that interest in those specific factors come from. In a very similar environment as to what we're experiencing now, where the markets behave very similarly as what we're experiencing today, when you entered the risk aversion phase of the cycle, that's what really stood out. And so that's what I'd focus on in 2023.
Let's round out the discussion with the work you're doing alongside development of Trahan Macro, you're working on this macro specialist designation that you've created. So tell us about the original idea as you formulated it and what you're hoping to accomplish there.
I'll give you the background before I tell you how this came to be. Unlike most strategists on Wall Street, I've never been an analyst. All I've ever done is macro. And so I kind of got into this role by accident in a way, or by luck, if you will. For a good chunk of my career, Dean, that worked against me. And I would say that things changed in 2006, 2007, when the world became a little bit more macro driven. And it has stayed that way in the wake of the GFC. So at the end of the day, a big part of my success in my career is that financial markets change toward what I do well. And there definitely was a little bit of luck in that. What put me on the map is it all happened after that event. So I realized a long time ago that the industry was very bottom-up centric. We asked people to do the CFA program, which helps you understand how to analyze companies. It doesn't make you a good investor. So for the longest time, I'm pitching this strategy stuff that looks very different from what everybody else is doing. And I would find myself educating people on the business cycle, the importance of how Fed policy relates to the stocks you own in your portfolio at the end of the day. That led to publishing a book in 2012 called The Era of Uncertainty that talked about how in the wake of the GFC, we would be in this slower growth world. And that meant that we were going to see more crises, et cetera. And in there, I showed a lot of the basics, if you will, of this framework and left it at that. And in 2016, I decided that I would kind of road test this idea. And so I prepped a series of seminars, and I forgot what the exact title was, but something like Introductory Principles to Macro for Financial Markets, something like that. And in the first half of 2017, I did a half-day seminar in 6 different cities, starting with New York. So I did Toronto, Boston, Chicago, San Fran, London. I didn't know if 10 people would show up. And it was insanely well attended. I think 143 people showed up for the first one. So I was a little bit stunned. It showed me how much appetite there was for understanding macro. And so that's what planted the bug in the back of my mind. Then it became, well, how do I pull this off with having a day job? So I just didn't have the circumstances to do that. And when the pandemic hit, I'm working at UBS at the time, but I remember having this conversation with my team in the midst of the pandemic. So this is March 2020, pretty early on. We all resigned to go do this project. And so everybody thought we were nuts. We didn't start publishing research until March of 2021, but we were working on this program. So in structure, it's very similar to the CFA. There's 3 levels. So we use the Canvas platform, and so it's all online. We use Pearson testing centers, and so it's the same structure in that you do level 1, you go take your exam, you move on to level 2, etc. We launched this in early November. We called it a soft launch, and we just started marketing it last week. We had our first meetings, if you will. It's not a substitute for the CFA. It's a complement for the CFA, which teaches you how to analyze companies, and you need those tools to be successful in this industry. But you also need to understand all these other things. And that's essentially the void that we tried to fill, because you don't really learn these things in academia. When the CFA was first created back in the late 50s, early 60s, at the time, the average holding period is 8 years. If you're going to buy a stock and hold it 8 years, you don't need macro. But what you need to do is make sure you're buying the right company, the management. You need to know all these things. Now it's down to half a year, basically, the average holding period. And so your entry point is enormous. The example I give is if you bought a stock on Jan 1, 08 or Jan 1, 09 and held it 8 years, the difference isn't that tremendous. If you only held it 1 year the difference, is being down 27 or up 31 or something like that. And so the importance of macro, I would say, has grown because the world has changed, but we're still educating people for the markets of the 1960s. We're just trying to fill that void, if you will, between what you learn in academia and in different education programs like the CFA and the realities of what a career on Wall Street demands.
And where can people find out more information on the macro specialist designation?
Macrospecialistdesignation.com. We have a page on LinkedIn. We have a channel on YouTube, and so it's not that difficult to find.
Francois, thanks for your time today. It's been excellent to learn more about your framework and to hear a lot more about your current views. So thanks again for being a guest.
Thanks for having me.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.